I actually have two disclaimers today. The second one I'll get to in a minute. The first one is I'm in New Jersey. Don't hold that against me, but it may work against me today, which is because we're in the middle of a blizzard here. So fingers crossed. I'm so glad we're starting early because everybody around here is pretty much counting on losing power. So if we totally cut out, I do have a backup plan, but I'll probably be out for a few minutes before we get it up and going. All right, so with that, let's hope that doesn't happen. And first of all, I want to thank everyone for being here. And just to kind of lead in from that lead-in, what I am going to show you today is an approach to the market and indicators for telling which way it's going to go, which we do actually use in some of our completely automated trading systems. This is not going to be a completely automated trading system, but we do use these in them. And the reason that I'm presenting this right now is because it is so absolutely relevant to what the markets are doing right now. And the reason I have this quote up here, twofold. One, because I am going to talk about a framework for the markets, as we always like to look at the markets in a very logical and methodical way. And so when Mukesh described the fact that he likes our frameworks, I thought that was particularly apropos to what I'm about to show you. And the other reason I put this up is because it really is our objective whenever we do a presentation that you actually walk away feeling like, wow, I could really apply that as soon as like right now. And so today I'm going to focus on what I'm describing as a special situation workshop because of the extreme relevancy of it, and it's going to be all about how to sort out the new leaders from the losers. So how are we going to identify the market's next big winners? Well, we're going to focus on leading stocks that have two trends that enable them to move to the beat of their own drum. How are we going to identify the market's big losers? Well, you're going to discover these two hidden trends in the market that are sabotaging your trading success if you're not paying attention to them. So I do want to start by saying, however, that it's not your fault because until now, you can't see them. As a result of this webinar, you're going to learn the two hidden trends that pros focus on that enable you to see what you can't currently see. And you're going to learn when to expect the market to move higher and how to identify the next big bullish trend trades. You can also use this to avoid the trends going short. I'm going to focus primarily on the long side because I think that's where the bigger opportunity is, but I also want you to walk away with the ability to sidestep the market or the stocks that could be dangerously set up to collapse even though they don't look like it. Now, the way that we're going to do this is I'm going to take you through, as I said, a framework or a process. And the steps of this process in terms of identifying the opportunity are, first, we're going to take a look at the condition of the trend. Then we're going to understand the important price ranges that need to be traded. And at the same time, we need to consider the condition of volatility. And once we've identified that, then we'll identify leading sectors, both up and down, and then we'll look at short-term trading tactics so that we can really time our entries and make sure that we're in the right place at the right time. And as a result of all that, you'll wind up with the best leading stocks to trade. Sound good? Great. So the other structure that I'm going to overlay in this presentation is something that I call the market cycle structure. All right, now I don't want this to sound too like technical and geeked out. It's just a simple way to be able to look at the process that markets go through, even if they're in an extended bull or bear trend. And essentially what we're going to look at today is the fact that pick any place to start. I'm going to start right up at the top here, that after being in a bullish trend, leaders tend to get weak. When the leaders get weak, the market tends to decline. After the market declines, new ranges get formed, new leaders emerge, and the bull resumes. You want to look at this from the bearish side, just kind of flip it over and do the opposite. All right, now the beauty of what I'm about to show you is that you can see all this with a simple pattern. A pattern that's as simple as looking for the blue line to be over the red line. And I'm going to explain what this all means, but essentially when the blue line is over the red line, it's a bullish condition. And when the blue line is under the red line, it's a bearish condition. All right, and yes, I am going to explain how that all works. Now, this blue line, red line relationship will help you identify when the market is turning to the upside or getting weak to the downside. So, for example, here again, with just focusing on the blue line and the red line, here's a daily chart of the IYTs. So, yep, works on ETFs too. And the magenta line is a 10-day moving average, the blue line is a 50, and the green line is a 200-day moving average. Really straightforward. Now, when IYT pulls back to the 50, you might be thinking that this is a retracement that looks good. But with the blue line under the red line, you're not going to think that after this presentation. All right, and you can see the same thing happens up here when it breaks down below the 10-day moving average. This thing is already negative, and you'd expect it to continue to get weaker. You can see when it turns up, the trend is bullish, and again, falls down, trend is bearish. All right, so it's as straightforward as that, and we're going to use this to identify leaders that are faltering. We're going to use this to identify new leaders. Here's an example of the SMHs. You can see coming back up through the 50-day moving average with a bullish condition is telling you that this is likely to continue. It remains bullish as it consolidates, and so with this breakout here is one that you'd want to focus on the upside. And we're going to keep it that straightforward. All right. So what is this going to enable you to do? It's going to enable you to identify breakouts and breakdowns that you should follow for explosive trend trades. It's also going to enable you to identify the pullbacks that you should enter for lower risk trades. And it'll enable you to identify bases to buy for big, long-term, surprising trend trades. And when I say surprising trend trades, you can see in this example that the blue line goes over the red line while this thing still looks like it's pretty much a mess. And what I'm going to encourage you to do is to not look at this as something that you've got to act on necessarily immediately, but instead, this is oftentimes an early warning system that'll enable you to see when the trend is changing or likely to change before the price action really breaks. And we're going to focus in terms of price action on really straightforward support and resistance, so we can keep this as straightforward and simple as possible and demonstrate how powerful it can be. For example, these lines here that I've drawn of basic resistance, I think anyone could draw. The green line is a 200-day moving average. You can see you've come up through the 200-day moving average. The question is, would you want to buy the breakout if it happened? The answer is that it's been bullish before you got to the breakout, days before. So you'd know well in advance this is one you want to focus on. In terms of protecting yourself from tops, same idea, right? This thing is going sideways, IBM, going sideways up here for days. But all during that sideways price action, you can see that the blue line is deteriorating relative to the red line, which tells you that if it breaks down, you want to get out of the way. If you like to sell short, then this is the opportunity to find something to sell short. All right, so that's a quick glimpse of what we're going to cover. And what you're going to find is that it works on weekly charts, so you can get the biggest perspective of trends that you need. And you can keep it simple and only focus on daily charts. And in this way, you can really nail down your short-term trading tactics to be able to identify the exact days to enter trades that could last a few days or sometimes even several months, and you can do it with incredible accuracy. It'll also work on intraday charts, so you can see trend changes even before they happen on the daily charts. So imagine applying this to any stock or any ETF. All right. I find that the most powerful and rewarding trades are the ones that you can enter confidently before the crowd. In other words, you will know which levels of support you're going to trust and which levels of resistance you're not going to trust if you want it to break out to the upside, or which levels of support you're not going to trust if you want it to break to the downside. All right, and in doing this, you're going to be able to enter a breakout before everyone else rushes in. You're going to be able to buy that pullback when other traders are waiting for the recovery to look safe. And we all know if you wait for something to look too safe, what happens? You're late, right? You're just late to the party. And it'll enable you, as I just demonstrated, to get in during a base before it looks like the market is ready to move up. And probably most importantly, it'll help you exit before the market collapses. All right, so we created this webinar to share my favorite method for identifying great trades that'll help you become a much more profitable trader as soon as tomorrow. Now, I'm saying we because I may be the presenter here, but I actually have a team behind me. All right, MarketGauge has been around since 1997, and we've been dedicated to helping people learn how to actively invest or trade safely and profitably. Our passion is finding better ways to profit from trading through automated trading systems and simple but professional caliber rules-based trading strategies. And that's what I'm going to focus on today. Our mission is to provide an environment and a resource where anyone can benefit from our decades of trading experience, and our passion is to simplify building wealth and income from the markets. So we have 3 partners with over 117 years collectively of unique trading experience and a dedicated staff who are all working to help you reach or even hopefully exceed your trading goals. Now, Keith's not here today, but he's my co-founder, and he turned $10,000 into almost $1 million, $996,000 in 18 months as a floor trader in the gold market. And he did it with a relatively simple system. Then he went on to build one of the first market analytics platforms called MarketVision. This thing was so far ahead of its time, it had Windows before Microsoft. Then he went on to manage money for one of the biggest and most successful hedge funds in New York, Millennium Partners. It was a quant-based hedge fund, and it kind of launched us into our systems development. Now, he met his wife and our other partner, Michelle, on the floor. She was a floor trader as well and a market analyst for some of the biggest firms of her time. But she also has a master's degree in special education. That's one of those unique qualities I was just referencing. And she's used that throughout her trading career to help school districts modify their curriculum for kids with special needs. She also was named by MarketWatch as a top Twitter account investors need to follow. And for myself, I've actually worked with Keith since 1990. I joined him on the floor as his assistant. I got a seat on the floor myself, traded futures and options on commodities on the floor. And then we both moved up to the Millennium Partners hedge fund, where we started trading off the floor and building computer-based trading models, many of which are still kind of in use with us today, and we share with our members. So we've developed numerous applications, trading systems, training courses to help thousands of traders trade with the MarketGauge Professional Edge. And when I say Professional Edge, it's because many of our systems, indicators, and analysis have been on professional platforms such as Reuters, Bank of America, Fidelity, Bridge, Barron's, Townsend Analytics, ILX, and more. So, as I've said, I want this to be you. I hope that by the end of this presentation, you'll be saying, wow, I wish I'd seen this a long time ago. And I hope that you'll start using it, whether you trade options or not, as quickly as possible. So as I was saying earlier, pros look at the market differently. All right, pros look at trends that you can't see on your ordinary charts. And that's what we want to look at. We want to look at 2 trends and 3 conditions that I think every trader should know about every trade. Now, the first of these is leadership. So leadership is the true price trend, right? You don't see it in your candlestick charts, all right? But what you need to know is whether or not your trade is leading, following, or just moving in the opposite direction of the overall market. And we're going to get into these in a little bit more detail. The other thing you need to know is volume. But not the volume that you see on the bars at the bottom of the chart. You need to know what the true volume trend is and whether or not it's supportive of the current price trend. And the third thing that you need to know is volatility. And volatility, again, may not be exactly what you're picturing when I say volatility, but I'm going to keep it really simple. When I say volatility, I mean you want to know whether or not your trade is trending, overextended, or consolidating, which would mean it's getting ready to move. Now, when you take the right conditions of each one of these three trends or conditions, that's where you get the biggest trades. So if you've got leadership in the right place, if you've got the right volume trend, and if you've got the right volatility pattern, that's what leads to the biggest profits, and that's what we refer to as triple play trades. So let's take this concept of triple play trades and these three conditions in the market, and I want to apply them to the market and then the market cycle structure and show you the opportunities that exist right now in the market. All right, so again, the market structure is simply that we want to focus on whether or not the leaders are getting weak. Is the market declining? New ranges, emerging leaders, bull trends. We'll walk through the process, apply it to the markets. So what do we mean by market leaders faltering? Well, recently we had a little bit of a hiccup in the market, right? February turned out to be not such a nice month in the market. Now, the markets actually peaked on the 29th of January. However, you'll see that IYT here, one of the leading sectors, had already started to sell off by the 29th. In fact, the leadership line here, which is the blue line versus the red line, was already turning negative. All right. So the blue line is a short-term measure of market leadership. The red line is a longer-term measure of market leadership, and the black line, which I'm not going to spend a lot of time talking about in this presentation just because I'm covering so much else, but it's an even longer measure of market leadership. So if you think about it, what we're measuring is whether or not leadership is getting stronger or whether it's getting weaker. And if we look at the leading sectors in the market, and you don't have to make this complicated, I'll show you a list that you can reference for free in a little bit. You look at which industry groups or which sectors are leading. You do not want to see them falter. What does falter mean? Falter means your leadership starts to break down. If you see leadership breaking down in terms of the leadership indicator and price breaking down, it could be as simple as breaking below the 10-day moving average. Even worse would be breaking below the 50. Now, as it turned out in January, everything was so extended over the 50-day moving average that you didn't need to wait until then. But the point is that the SPYs topped out here, but IYT was already topped out a week even more beforehand. And it wasn't just the IYT. One of the strongest market sectors in the market throughout 2017 was the semiconductors. Now here's a view of the semiconductors on a weekly basis with the leadership line, the price leadership line on the top. I still have the volume one on the bottom. We're going to get to that later. But you can see that late in 2017, semiconductors peaked. They sold off a little. Then in January of 2018, they rallied with the rest of the market. However, when they rallied with the rest of the market, the leadership line never got positive on a weekly basis. And the market barely even made it, or the SMHs barely even made it to new highs. So while the Qs in the overall market were melting up, the prior leader, while it looked like it was melting up because it was coming off of a correction, really wasn't at all. It hadn't resumed its leadership status. So the market wasn't firing on all the same cylinders that it had. Right? So these were two of several market leaders that were faltering. And as you can see, it's pretty easy to see when you focus on whether a trend has leadership or it doesn't. Now, The end result of that is we got something pretty ugly, right? We got a pretty nasty sell-off. We might have described it as hellish, scary, and for many traders, this was pretty painful. But what I want to show you now is that when something like this happens, you have a choice. You can either worry about all the bad things that it has happened. You could worry about maybe the money that you just lost. Or hopefully after this, you'll be able to look at this and see it as an opportunity. Now let's be clear. When the market sells off like this, you can be sure that I was a bull going into this. I was extremely bullish. I was extremely bullish before it started melting up. So when this thing sold off, I definitely took somewhat of a drawdown. Now, without going too far into my trading, I could see that something was wrong. I could also see that the VIX was bubbling. So quite frankly, I got lucky. I got lucky because I saw it coming with what I'm about to show you, and I bought the VIX. And the VIX doesn't usually explode the way it exploded this time, all right? But having said that, it still was not what I was anticipating in terms of the overall market. But I didn't take that as a negative. I looked at this situation, I said, this is great, all right? Everybody's been waiting for a sell-off, and now they got more than they bargained for. And when that happens, it creates huge opportunities, all right? And the good news is with this, regardless, and if some of you got hurt on this decline, believe me, I'm not cavalier about that. But the good news is that when you get this kind of volatility, the opportunities stick around for longer, all right? So remember this process that we're gonna walk you through, and this is a simple checklist that if I were you, if this is making sense, I would write this down. All right, I would write this checklist down, not because it's brilliant, but because sometimes you just need to remind yourself where we are in the process. So the markets get smacked. What do? You want to check the condition of the trend, right? And again, I'm not going to make this really complicated. Then while we're doing that, we want to check the condition of volatility. So these charts aren't required, all right, but they're an illustration of just how big this opportunity is. And the reason I'm saying that they illustrate the opportunity is because they illustrate the level of volatility that we just had. So this chart here is simply a representation of how wide the Bollinger Bands get, all right? It's not rocket science. So Bollinger Bands are really wide, volatility is really wide. So you can see going back that this doesn't happen very often. So this is 2016, right, since we've been this high. And prior to that, it was the Chinese flash crash, 2015, right? And then you have to go back. I guess you could look at this one in 14, and then you have to go all the way back to 2011, all right? So this level of volatility creates opportunities for longer. All right, and I'm going to show you how to take advantage of it. Now, another way to look at this is simply to look at the average true range. So this is the 10-day average true range of the SPYs, and you can see that as it was collapsing, it was incredibly large. What does it mean? Just a different measure of volatility. All right. Now, the reason that this is important is because, as I'll say it again, is when you get high levels of volatility, the next thing that tends to happen is either a reversal or ranges start to form, right? And that's going to be our next step. But before we get there, what's the trend? All right, what's the condition of the trend? The overall trend here, this is a daily chart. The green line is the 200-day moving average. The blue line is the 50-day moving average. As ugly as this looks, the trend is still up, all right? Now, I know that sometimes doesn't offer much comfort when there's that level of volatility, but that's why you need to be able to take a step back. Now, one other interesting level of volatility was I just did a quick chart of the 2-week percent change. And again, all I'm looking for, and all I would encourage you to do, is put things in perspective. So the big picture perspective here is that on a 2-week basis, at the time of this chart, we were down as big on a 2-week basis as we had been since 2011. all right? That's pretty big. And the next time before that, you had to go back to the financial crisis, right? So again, if you understand that after major expansion, whether it's to the upside or to the downside, the thing you should start to anticipate or expect is either ranges are going to form or reversal is going to happen, all right? It doesn't mean I'm picking a top. It doesn't mean I'm picking a bottom. In fact, what it really means to me is that the next step is to look for important price ranges, all right? Again, when you have compression and ranges, it will lead to the breakouts that lead to the extended trend trades. When you have expansion, it's going to lead to compression. Now, you don't need to figure out, well, how am I going to know what's what yet? Because I'm going to suggest that it'll be obvious, all right? So when I say it'll be obvious, again, take a weekly chart and look at after the market has most of the time any major sell-off, it will figure out a pretty well-defined range to trade in, all right? And then you're going to use that range, right? So you can see the ranges here, you can see them here, whoops, here, you can see the ranges here. Again, I don't think you need to be all that sophisticated with technical analysis to really get onto the right side of the major trends, right? If you can identify where the ranges are, then you can identify kind of where we are in that process. Now, as we look at the market when it looks like this, what are we thinking? We should be thinking, well, it's definitely going down in the short term, but the next step is it's going to start to define some ranges. So unless you've got a way to catch a falling knife, then you step aside and know that I'm going to wait for the ranges to happen. And you know, taking a step back, I shouldn't be totally surprised. Leaders have faltered here, but we're still in a bull trend, all right? So if I then go to the daily chart about the same time, even be exactly the same time, you can see that the market at this point is trying to start to establish a range, Doesn't look that way here, but if we look at the IWM, you've got the IWM sitting right on that 200-day. Now at this point, Dow testing. At this point, on this close, you don't really know, right? You don't really know. If, however, you have the perspective of, I'm going to wait to see where the ranges form. I can tell you this already. This is the top of a potential range. This is the top of a potential range. This is a top, right? Right? So at the very least, I could say I can just remain either out of the market or bearish until it breaks out of the top of that range. All right? Take it one step at a time. So let's fast forward a little bit further. Now, as it turns out, this bearish day had one more spike down, hit the 200-day moving average on the SPYs, and then back in. So I draw this line. I say, okay, I'm back in what looks like the range. Here's the other side of this range. Now you can see how the market since then traded. So it came up to the top of the range, kind of had trouble, but established that as a potential range area. And as of this chart right now, it's still kind of a potential range area. But earlier I said that the bigger the volatility, the bigger the opportunity. All right, I'm going to come back to this, but the opportunity here is that now the ultimate high and the ultimate low, this whole correction, right? So most people look at corrections and they think, oh, I just wish I could get a correction. And when it comes, they totally screw it up, all right? They don't take advantage of it. And I think that most people don't take advantage of it is because they think that they have to pick the bottom. Right? They think that they have to buy it down here. So what happens? And tell me if this happens to you. Nobody else can see the answers. As it's going down, if you're a bull, you keep trying to pick the bottom. And if you're prudent, you keep getting out because you don't want to get completely crushed. So you wind up getting chopped or getting hurt little by little until you get frustrated. All right? Or you just buy it way too early and you hold on, and that's painful too, right? Or you buy it, you get out, and then it's back up here. And what do you think? You think, oh, well, I bought it down here. I got stopped out down here, so I totally missed it. All right, you didn't miss it. What I want you to see is that your opportunity with a sell-off, and I'm going to show you how to take advantage of this, your opportunity with a sell-off really exists, and I'm not going to say it ends there, but in this box. So the bigger the sell-off, the more volatility you have, the more time the market's probably going to spend consolidating, chopping, moving around, confusing traders. And rather than be myopically focused on what it's doing in all this, you could be looking at this, stepping back and saying, here's the big opportunity, or here are the bigger ranges. Now I want to see what the leaders are doing. I want to see how the market's reacting to the ranges, and you're going to use this high and this major low as your benchmarks. And if you get good consolidation inside the range, then you can tighten it up and say you can use this level as your benchmarks. What do I mean by my benchmarks? All right. What I mean is that once you've identified the range, now would you all agree that you could identify these ranges that I've pointed out? All right. And you might even be thinking, yeah, I can identify them, but I don't know what good they're going to do, right? They're not hard to identify, right? Good, great. So when I say you're going to use them as benchmarks, the simplest way to identify leaders, even without the blue line, red line, would be that if you have a stock that is breaking out of its high that it set back in January, right now, it's already running ahead of the market, isn't it? It's a leader. It's a leader. So this sell-off basically enables you, without any special indicators, to identify which stocks, which sectors are potentially the next leaders. Now, it's not perfect, but that's a huge opportunity. And the longer it takes for the market to get back up to that high, the more opportunities are going to come your way to identify leaders. So do you see what I mean now by the bigger the volatility, the bigger the opportunity? Because it's going to most likely take even longer for the market to take away that edge for you. The edge is you know what to look for now. Now, the other thing that the bigger volatility does is it frustrates more people. It flushes more people out. And the more pain that the market can inflict on people, the longer the next move up is likely to be. Not guaranteed, but likely to be. All right? So that's the big opportunity. Now, as the market's confusing everybody in here and in these ranges, we're now going to identify who the leaders are, who the laggards are, and those are the places that you want to be. You want to be in the leaders when the market, before the market breaks out to new highs, and you don't want to be in the laggards because those are the ones, if the market continues lower, are going to most likely get absolutely smashed. All right, and if the market makes it up to new highs, you want to make sure you're not in the laggards either, because those are the ones that are going to get smashed when the market inevitably just corrects, even if it's a little bit. Make sense? All right. So with the market in a corrective phase, and all of us very calm and not worried about whether overall the market's going to go up right back to the highs or back down to the lows. We're just focused on, it's a bit of a mess now. Let's see which areas of the market are demonstrating strength. And let's focus on those. Leading sectors. I say both up and down, but I'm going to focus on the bulls because we're still in the bull trend, right? We've got massive volatility, so expect a range. We're in a bullish trend, so expect those ranges to break to the upside. All right? And expect that with the leading sectors and the leading stocks within the sectors. So that means that in the market's cycle here, we're basically right here. Now, does it mean that the market can't decline again? No, it could decline again. But when are we going to know that we got to be worried about that market decline, like really worried about it, without trying to time the market? when it breaks that low that it put in January. At that point, we've got real problems. And at that point, it might be that the bull trend is in real trouble. But for right now, until that happens, we're still in a bullish trend. We'll focus on new ranges and we'll identify new leaders. And if the market goes back to new highs or even is range bound for a while, there's a good chance that these new leaders are going to have explosive trend trades to the upside. Now, which stocks? Someone's asking, what about shorts? Look, if you want to sell stuff short, then do the opposite. Focus on the stuff that's not breaking out to new highs, but instead breaking its January lows. All right? Those are the leaders on the downside. Now, I keep saying focus on sectors, right? You don't have to, but it's easy, right? There's many places you can find lists of sectors, and in our site, marketgauge.com, there's a sector summary page that's free, and it'll tell you in a very powerful way the leading 6-month moves, because we're rank it based on 6 months. Now we use 6 months for reasons that have to do with our research that I won't go into, but I'm just telling you that's the reason that it's categorized that way or sorted that way is powerful. So all you have to do to identify the leaders is to look at this table and maybe get the same table somewhere else, right? But what you can't see on this table is whether or not they're really leading or whether their leadership is faltering. You can see which ones are the strongest, all right? So it's a good start right here. All right, so you want to keep an eye on those. Now, what are we looking for? Well, let's go back and look at a prior time where we had a market correction. So this was a really confusing market correction because, and while it may be hard to admit now for a lot of traders, but back before the election, the market really wasn't all that sure of what was going to happen. In fact, one of the only things it seemed to be sure of was if Donald Trump got elected, the markets would collapse. Now, I'm not saying that because it was my opinion. It's because of data that actually suggested that every time the polls leaned towards a Trump victory, the market would get weaker. All right? So that's not an opinion. That's just the way the markets were trading. Regardless, it was a confusing time. They're always confusing unless you step back and just look at what was happening. So during this period when the market was selling off, look at what was happening to the leadership line in the financials. All right? The leadership line actually from the beginning of October turned positive, and coming into the election, the financials, the XLF, was basically breaking out. So my position, and I said it publicly on the blog, was that regardless of who wins, the financials and the transports, which you're not seeing here, are going to rally. Not because I had any brilliance in who was going to win, or not because I thought that the market would rally if Trump got elected. I really had no idea. What I did know, though, is that the market was correcting, just like we've seen it correct recently, but in the face of that correction, the XLFs and the transports were showing good leadership. So unless the market completely melted down and everything went down with it, the leaders were going to rally. That's just the way it normally works, all right? And it's as easy as being able to see that blue line over the red line and stepping back and focusing on it. Now, if you were to actually go inside the financials and look at an individual stock, let's say Bank of America, you would see the pattern just as clearly. In fact, if we look at Bank of America, here's a 200-day moving average, here's a 50-day moving average, and you can see as Bank of America comes through the 50-day moving average and corrects back down to the 50-day moving average, your leadership line is improving. So that's telling you that this break to the upside probably has some legs, right? Just like when this break to the downside happens with a negative leadership line, it's probably in trouble. And when it breaks to the upside with a positive leadership line, it's probably got some legs. Now, if all you did was draw a resistance line there that lined right up with the 200-day moving average, and you saw that you had strong leadership over the course of the last 4 weeks, would you have been able to anticipate that this break over the 200, over this base, might be a good place to enter. My guess is you probably could. All right, and then when it corrected back down to the 50-day moving average and bounced off of it with a leadership line that was turning bullish, you could have been a buyer in and around $15, and by the time it got up to the election, you'd be at $17, probably willing to sit through the election when you're up, what, 15% on the trade, all right? And your leadership line is strong. So this is what I mean by this enables you to focus on the bigger picture and be in early, be focused on stuff that you should focus on days, even weeks in advance. It doesn't have to be hurry up, make quick decisions. You can sit back, think about it, all right? So that's how new leaders emerge. Pretty straightforward. So with that, let's take a look at short-term trading tactics, all right? And we're going to focus on the same thing. For right now, so far, I've focused on this idea of the blue line over the red line, leadership. And the reason that I focused on that is because of something I said earlier, which is that the pros focus on leadership, right? And that trend is one of the most important trends in the market. It's the trend that will determine whether or not support or resistance is going to work. And someone's saying strong money was buying all night of the Trump election. Strong money is what creates these leadership trends. That's what I mean by when I say the pros look at this. And if you're not looking at this, you're missing the most important trend. And you can't see it if you're just looking at candlestick charts. Now you can tell by my charts, I look at candlestick charts. There's nothing wrong with them. It's just not the whole picture. You've probably heard that 70% or more of a stock's move is from following the market. So that means if you're not trading a leader, you're just going to get whipped around by the market. You might as well just go trade the ETF of the whole market. But if you are trading a leader, you can buy the dips more confidently because they'll get pulled down by the market, but they'll recover faster and bigger. All right? Leaders have the best moves after market sell-offs. This is why I'm saying that when the market corrects, people always want to buy the bottom of the correction. You're much better off just being happy that it's correcting and then seeing the whole picture the way I'm describing it for you right now. It's not a one-day event. You don't have to catch the low. The leaders have the best moves after the market sells off. All right? So here's another example, the semiconductors. Now, again, I'm going back in time, so you can see that this happened before the election. This happened coming out of 2016 lows, which were even more ugly than the election, which created huge opportunities, as you can see here in the semis. All right, so if we just look at the ETF, the SMH, on a weekly basis, and in both cases, I've got the SPYs over here on the right so you can see what was going on in the markets. You can see that you can be a little early here in the sense that each time the market popped up here, you could see semis were trying to lead. Semis were trying to lead. Semis were leading here. Draw the big resistance line that needs to break, all right? So when that breaks, by the time that breaks, you have been in a strong leadership position for weeks, all right? So when the market breaks to the upside here and you want to know what to buy with confidence on that breakout, you want to buy the leaders, right? One, because they're most likely to continue, and two, because if the market corrects, which it did here, right? So if you were buying the market and you bought the market as it was breaking out, you really got your nerves tested if you were trying to hold it down here. Right? You're sitting with a loss there. You're underneath the support level. But if you bought the leader and you bought it at the same breakout time, it never came close to your break-even point. But more importantly, you often get a second chance with these market reversals, especially if they're big. So here's a perfect example of how it takes the market a couple tries to get out, and when it takes that second correction or that first correction back to test the market, and your leader doesn't even budge, then you know you've got a second opportunity to buy new strength in that leader. Now, I can't guarantee that your leader is always going to have the kind of move that we've seen in the semiconductors. It's borderline historic, but that this pattern repeats over and over and over. All right, seen it for decades. Now, as I described with the banks and Bank of America, it's even more powerful when you go into individual stocks. So NVIDIA, for example, pay attention to the dates here. Okay, NVIDIA turned its leadership line turned bullish in July or August of 2015. All right, that's in here. So when the market made a new low, NVIDIA had already broken out. It was already a leader. NVIDIA was a buy here. Right? So if you had NVIDIA and the market did this, NVIDIA didn't even pay attention to it. It just kept going up. But you got your second chance again. Always look for a second chance. The second chance is that NVIDIA gets pulled down in the January situation. And as soon as it starts to head back up, the markets are starting to head back up. They're coming off a bottom. This is how I like to buy bottoms, right? I don't know that this is necessarily going to be a double bottom, but again, if you just established your ranges, you could see it tried to take out the bottom of the range. It had another range here. This is that range that should break out to the upside. Now, you don't want to buy the SPYs. Turn around and buy the leader. Buy NVIDIA. NVIDIA went from 30. It's got up maybe even higher than 240. Now, I realize this is a bunch of years later, but this thing was the best performing stock in 2017. And it was a monster in 2016. And it was clear by focusing on the leaders. All right? So the good news is market corrections make this easier and more powerful. But what if you don't have a market correction? And what do you do kind of in the interim for your short-term tactics? So let's take a look at how we use this just in general. All right, so going into 2018, January, there wasn't much of a correction at all. However, there was sector rotation. So the sector rotation in one of the sectors happened in the retail area. So the retail XRT, retail ETF XRT, turned positive as it was breaking the 200-day moving average. You seeing a pattern here, all right? Not necessarily all that complicated. The markets trade through major moving averages. Markets create bases, and you want to know which base to buy. Look for the ones where the leadership line is positive. When you see a positive leadership line, there's a good chance that that breakout will continue. Now, this is the worst performing sector probably of 2017, leading off the end of the 2017, the beginning of 2018 with a monster move, all right? It was becoming a new leader. And as I've demonstrated before, if you then go down into that sector and find stocks that are even stronger. So look at Kohl's. Kohl's had broken out of its 200-day, consolidated back down or corrected back down to its 200-day, and then turned back up at the same time that XRT was turning up. So it had already basically broken out of its base, and its leadership line was turning higher. So instead of buying XRT that goes up a couple of percent, you could buy the leading stock, which goes from 40 to 70, not quite a double, but pretty close, right? Now, on top of that, when you know how the leadership line works, wouldn't you be a lot more confident in holding on through this move up here when you can see the leadership line is so powerful? Of course you would. All right, so as I demonstrated earlier, just like it's showing when things are likely to go up, it's really good at warning you that things may not look so good coming down. What do I mean by that? In this case, Exxon looks like a pretty good breakout here. Why wouldn't this pullback to support be something that we could expect to hold? Well, because that pullback to support was actually happening in a condition where the leadership had already completely fallen apart. All right. This means if Exxon gets weak, it's going to get even weaker. All right. And this is exactly what I mean when I say you want to get out of the way of these things where they've got this hidden deterioration pattern. Or over here where it's breaking down from the 50 or the 200, this is just the opposite of what I was showing you on the base. This should have been some good support in here, but this break of the 50 and the 200, too much, no leadership, and you got what you should expect to get in a situation where it's just weak. Now, oftentimes, you will see this leadership coming, or this deterioration coming for weeks or months. So here's an example, again, where the IYTs broke out to new highs. So they're breaking out to new highs for this move, and the leadership is just negative. It's downright negative, and it's been diverging for months. So is this a new high that you want to buy? Absolutely not, right? You can see it coming from a mile away. Now, let's say it's your favorite stock and you absolutely have to own it. You don't want, and you don't care what the leadership line looks like. Okay, you can do that, all right? But here's what will happen if the leadership line is wrong. This will continue to go up, and the leadership line will almost always catch up with it. So what do? You go ahead and buy it, but if it starts to break down, you get out of the way, all right? So that's how you break the rules. I don't recommend it, but that's how it will typically work. Now, it gets better. It gets better if you take the same concept and apply it to volume, all right? See, most people, and it's not your fault, look at volume in a dangerously misleading way, and it's because that's the way the books taught us to look at it. All right, the most important thing about volume is not that the volume expands necessarily every time the market goes up. All right, the most important thing about volume is that its trend is in alignment with the direction of the price movement. All right, and you cannot see this very easily going bar by bar. In fact, I would argue it will just drive you crazy. I know it drove me crazy. I programmed dozens and dozens of volume indicators to try and figure out how to get bar by bar volume to be helpful. Was never able to do it. I always have loved volume, and this is by far my favorite volume indicator, all right? And it often will precede price. Now, having said all that, volume is still only a confirmation. It's not a trigger, all right? Now, here's an example of Amazon. I'm going to talk about Amazon a little bit because Amazon is something that I've been in. In fact, most of these examples that you'll see in any of my presentations are stuff that I know about because I've been in them. So I have liked Amazon for a while. It breaks out up here. I want to be bullish. But if I were just looking at these volume bars to try and figure out whether or not all this was bullish, I would have no idea. And I would venture to say, nor would anyone else. All right. If anything, I could argue that the big volume here at the highs was not good, and that the big volume down day is not good, and another big volume down day is not good, all right? It just wouldn't add up very well. But if I just look at this chart, so this chart is another blue line over red line, and the reason it is because you read it exactly the same way as the price chart. So the trend performance, where the leadership line is on the top and the volume performance is on the bottom. Now, you just look for the same pattern. I want to see a blue line consistently over the red line. And as I said, oftentimes it will precede price. So in the case of Amazon here, this volume is pretty strong during this period here. And the leadership line, not strong at all. It's just neutral, right? But when Amazon broke out here, I was a buyer. I was a buyer because it was starting to break out on the leadership line. Volume had looked good for a long time, and one other reason which I will get to later. Now, one of the things that people always ask is, how can you use this, or do you use this with options? Now, as I said earlier in this presentation, I was anticipating for longer. I was way early, thought I was completely wrong that the market would have somewhat of a melt up. Also, if you know me, I have a big emphasis on what happens in January. So this also was a January breakout as well. So with that, I had high hopes for Amazon. When it was trading around 1200, I bought the 1500 April calls. So how do I use this with options? I look for stuff that's really set up. So this had leadership, it had volume, it had the January, and I'm going to show you later how it had volatility. So I bought the 1500 calls for $3.88. This isn't as high as they got, but I think this is pretty close to where they are now. And I still have them, all right, $80. Now, to be completely transparent, I put some spreads on them so that, unfortunately, I won't collect $4 to $80, but they're still working. But the point is that I wouldn't have the confidence to do that, and I wouldn't have had the confidence to stick with it through everything that's going on in the market if the leadership lines weren't there. So can you use it with options? How do I use it with options? That's one way. The answer is yes. So another interesting point, if I go back to retail, and now we look at the volume. So retail we just talked about, right? XRT for some reason was turning higher after being a dog all of 2017. But the truth is it wasn't just showing up in the price. It had been showing up in the volume since October, all right? So here again, the volume was leading the price. I was actually very vocal about XRT turning and bottoming in here. It looked like I was wrong in here, right? And in fact, I was wrong because I thought it was going to break out. But now you know how I look at the market, and here I admitted that the breakout here didn't look like it was going to happen. But after this happens and volume remains strong, what would you be thinking? I'm not going to be the buyer down here, right? I'm not that crazy, but I do know that when it turns higher, I don't want to miss it. All right, and then calls, I showed you this, but now you can see it with volume. Much more convincing, right? Pretty straightforward and simple, right? So there's one thing left, volatility. And this one, the way I use it is, I think, the easiest of them all. There's a lot of different ways you can look at volatility, and all we do is use Bollinger Bands. Right? And if all you do with the Bollinger Bands is just look to see if they are super expanded or super compressed, you'll be way ahead and you'll get what you need. All right? So the way you look for the volatility for the biggest opportunities is to see that it's compressed. All right? If you're just looking at the absolute price level of price, meaning what the trends look like on the charts, you'll miss half the picture, because the picture you're missing is the relative picture. How is it performing relative to its past? And what's normal for volatility here? Is this thing unusually compressed or unusually expanded? All right. If it's unusually extended, we've already talked about, what do you expect then? You expect either a reversal or a range. If it's consolidating, you expect that a breakout from that consolidation is going to continue. And now that I've just shown you the leadership line and the volume line, which direction of that compression will you expect to be the one that works? Because sometimes there's head fakes, right? You want to be a buyer of the breakout in the direction of the leadership line and the volume line. Now you can look at this on dailies or on weeklies. Here's some examples of the weeklies, and now you can see why I was overly ambitious perhaps with Amazon. The weekly compression here was great. Everything was lining up with Amazon. All right. So while I never honestly expected it to get to 1500, all right, that was the delta that I wanted, for those of you who know options. As it turns out, it's trading over 1500 now. Apple, another example of nice, tight, weekly squeeze and volume that was in gear and a leadership line that switched. All right, you don't have to, these are weekly charts, right? So once you see these, you just keep them on your radar. IYT got really tight, and when it broke down, its leadership and its volume went in the same direction, major correction. All right, so if all you did was use the volatility to know whether or not you've got a squeeze, and it's just that extra kick, if you like to buy breakouts, that's how you should use it. So this one happens to be a daily, a breakout of really tight squeeze bands and really well-defined leadership and volume pattern, right? Does this all make sense? Pretty straightforward. So these are the patterns you want to look for on stocks that are trading to the upside. And it's incredibly, I mean, it's so much more powerful after a market sell-off. All right, so I'm going to do a quick review, and then we're going to play a quick game, and then I'm going to wrap it up. All right? So before you trade, what do you want to know? You want to know those three conditions, your leadership, your volume, and your volatility. If you're missing one of them, not so bad. If you're missing two, not so good. All right? There's better stuff out there. All right? The best ones are obviously when you've got all three together, and I say it's perfect for options just because the timing component of options is so important. So I have this little game just to see whether or not you've been paying attention, or to see for yourself whether or not you think this is helpful. And so here's how it works. If you'd like to play, all you have to do is say buy, sell, hold. Obviously, I've got a chart, and it's covered up with this big red box. I'm going to move the big red box across the chart at various points. You're going to tell me whether you would hold, meaning you wouldn't do anything, or whether you'd be a buyer, or whether you'd be a seller. And let's see, you know, I can get a sense of whether or not I went too quickly, or you guys just didn't get it based on your feedback. So right here, you've got, I have the price leadership line on the top and the volume performance line on the bottom, and candlestick chart. I'm not going to tell you what the stock is because I don't want you just to be swayed. So I would look at this, and again, 10-day moving average is magenta, 50-day moving average is the blue. It's breaking out of this range in here. Is this something you would buy, hold, or sell? All right. So we've got mostly buys, a couple of holds. We don't have any sells. All right. Let's see. I lost my mouse. Let's see how you did. Here it is. Okay. So two things. Yes, that was a good area to buy. And the leadership line continues higher, right? So I want to point something out. If you bought it in here, really nice break to the upside. The other place you could have been a buyer would be over the 50-day moving average, right? And if you bought it over the 50-day moving average, you might get a little freaked out by this day here. I don't remember what the news was, but obviously this is a bad day. Now, when you get a bad day like that and your leadership line holds up and you get a range, that's your second opportunity. So you get these second opportunities frequently. Now, this was earnings, so I am not going to say that this was as much of a second opportunity as it normally is, and I'm not going to tell you to use these to anticipate which way an earnings event is going to go. Don't do that, all right? Earnings could go either way. There's nothing, in my opinion, that predicts earnings. All right. That said, if you had been a buyer in here, you might have felt much more comfortable holding through earnings. At least that's always my approach. And as it chopped around in here, you should have had the confidence, right, to stick with it because your leadership line was still good. And you could have drawn this as your range, and everything looks pretty good. Then it breaks out to new highs. You're thinking, oh, this is great, but it pulls back. Now, when it pulls back, this is an important test of support, right? So at this point, what should you be thinking? Buy it, buy the pullback, hold on to it if you're already long, or dump it if you don't have it. So buy, sell, hold. Just keep it simple. Pretty much everybody got the first one right because nobody said sell. Now we're getting sell, sell. Okay. Got to hold. Some holds, some holds. Okay, let's see. All right, tough hold. However, in your defense, I didn't want to go bar by bar. So if you had been a hold in here, you had another chance, right, to take another look at it. And by the time it was really breaking that level I was showing you, I think you all would have agreed, sell, right? What's my point? All right. If I had done it bar by bar and I had left it at this level, what would you do? I think you would have been pretty unanimous based on the class that you definitely don't want to be in this thing when it breaks here, right? Now, here's what I like about this chart is it breaks down here. So even if you really like this stock and you at this point have to say, you know what, as much as I like it, I got to get out. As it comes back to the 50, what would you do now? Buy, sell, or hold. Same place, right? Same price basically as the sell here. What are you going to do? Buy, sell, hold. All right. Everybody's saying buy. All right. Another example of yes, I would have been a buyer, and news gap down, right? But the news gap down, and what happens? The leadership line, well, I'm not going to say. What would you do now? Hold, buy, hold, or sell? Is this a breakout? Let's say you weren't in it. Is this a breakout you'd want to follow? Everybody's either saying buy or hold. And now saying yes. Yes. The second opportunity, right? Again, especially if you only get, and this is like a little secret pattern. If you get one bad day, right? This is the one bad day, whereas this is the one bad day, and it doesn't follow through on that bad day, and your leadership line holds up, like you can never predict the future. But when you see that, half of you is going to be like, oh crap. The other half is going to be, oh, this is great, right? Sometimes I add, all right? Because this pattern is what you're looking for, all right? The head fake to the downside, straight back up, and it just rockets, okay? So now it's heading higher. No reason to think anything bad about it. But now it's starting to correct. Buy, sell, hold. Buy, sell, hold. Oh, all in agreement. Gosh, you guys are so negative. Sell. You're right. I would say you were right, right? In here, why sit through all this, all right? But what now? Buy? I don't know. Didn't really make it up. I mean, that's a tough one. Didn't really make it up. And you wind up getting no real price action, all right? No real breakout. But now, so that's a good, this is a good example, actually. Let me go step back. So here, not really all that clear, right? Wait for it to be obvious. So with the obvious in mind, nice new breakout here. Do you want to buy this breakout? How many of you want to buy this breakout? Nobody? Nobody? All right. I'd say, look, regardless of the outcome, I agree. This is not an obvious looking breakout, right? Not as obvious as the other ones, right? Good thing, all right? And I don't even think I have to say, if it pulled back to the 50-day moving average here with this looking like this, would you be a buyer? No, I don't think so. But you know what? People love this stock. They love it. What about now? What if it were to break out of this range? We talked about ranges. If it breaks out of this range, what do you think? I don't know if I'm giving you enough information here. Actually, this is tough. I'm going to hurry us along. So if it breaks out of this range, now you'll have the ability to see this and this as you have this big green day. So that would help you, right? But I couldn't show you the big green day without making it too obvious, all right? So it did a pretty good job at showing you that it was turning to the upside. And now back up at the highs looks totally different, right? If this thing breaks out to the upside, as long as this continues higher, but you want to see the volume here too, all right? Until then, let's see how it acts, right? It's got to break out. Any guesses on the stock? Now that you can see the price, some people will probably be able to guess it. Apple, all right? So I actually showing people the same thing right around the time I was doing this, and I was a little nervous because everybody likes Apple, didn't want to tell them that the breakout, don't want to buy this breakout. But what this actually shows you is that, yes, the whole market got clocked, but the Qs never made it down to their 200-day moving average, and Apple was way below its 200-day moving average. Apple was down to 6-month lows, all right? Now, that's what you have to watch out for when you don't have leadership, all right? And when I said that's how you avoid the disasters, that's what I mean, all right? So there is more, but I have a limited amount of time to cover it. So if you'd like to discover more of the secrets and trading strategies that you can get with Triple Play, you can do it. We've got a Triple Play Advantage Trading course. I've just scratched the surface here. In the course, you'll learn tactics to minimize your risk. You'll learn specific patterns for intraday trades, which I couldn't cover in this. You'll learn rules for applying the indicators to common patterns other than just support and resistance. And it's 3 hours of streaming video instruction. So as soon as you become a member, you just log in and you'll have lifetime access to that training. And you'll get entry and exit rules for 6 specific different trade setups. I've just talked about it in general here. Now, if you were to just go to our site, you'd find that this is normally $697, but I've got a special offer for you. Not only will you get the training course, but we'll give you lifetime access to the indicators. Now, if we were to sell the indicators by themselves, they would be $497. Now, I have to make sure that I'm clear about this. You need to have a specific platforms in order for this to work. You're not going to find these indicators just on any platform because they're custom, right? So here's a list of most of the platforms. Here's a list of every platform that we know works. There may be other platforms out there. If you can create custom indicators, then you can do it. Now, when I say custom, I don't mean you just change an input on the duration of a moving average or something. That is not going to do it. All right, so TradeStation, Thinkorswim, Ninja, OmniTrader, TC2000, eSignal, Trade Navigator, Metastock, Visual Trader, Fidelity Active Pro. So if you've got one of those, you are in luck. In addition, I have a bonus. All right, we want to help you during all different market conditions, and we want to accelerate your learning and make your trading easier. So what if I handed you stocks and ETFs that have great triple play conditions, right, every day? All you'll have to do is log into our website and look at the results of scans. You don't have to install any software, just log into the member area, and we've got 2 sets of bullish scans and 2 sets of bearish scans. So we're telling you which stocks have the strongest or the weakest triple play setups. Now, in addition to that, I do a video every week, which is a mentoring video in which I take stocks from this list and I tell you which ones I would focus on and why. And I also look at the market conditions, current market conditions, and tell you whether I would be bullish or bearish. I almost like take you through that same process that we did earlier that has to do with the market cycle and the market cycle structure and the steps. So we kind of keep you on the straight and narrow so you're focused on bullish trades and bullish environments, bearish trades and bearish environments, and really be able to see how I use these indicators in all different market conditions. Now, this particular service is normally $97 a month. So that would be $1,100 for the year. But I'm going to include a full year of the alerts and mentoring as part of this special package. So the special package has a value of $2,358, and you're not going to pay $2,858. But in addition to that, we have started a live training session, Q&A session every month. And if you become a member now, you'll get lifetime access to that live monthly Q&A session. All right, so you'll have lifetime access to the course and lifetime access to these live monthly Q&A sessions. This means that you'll be able to ask questions in real time in pretty much every market environment. I'll also be able to give you personalized help with your favorite strategies if you bring the questions to the sessions. And yeah, they're all recorded so that you'll get to see the recording even if you can't make it live. In short, we want to make sure that this works for your style of trading and that you can adopt our approach if that's the way you want to do it. Now, we can only take 25 traders at a time because we're small, and we want to make sure that everybody who becomes a member gets up and running with as much attention as they need. And you're not going to pay $2,300. It's a one-time price of $497. All you have to do is go to marketgauge.com/MarketFest. So you'll get lifetime access to the course and the monthly Q&A, lifetime access to the indicators, and a full year, which is usually, as I said, over $1,100, $97 a month, of alerts and weekly coaching videos. So I cannot guarantee that this will be you, but I certainly want it to be you. So Jack wrote in my first 4 months, I have more than tripled what I have spent on the course on a small account trading one option contract at a time. All right, so can you do it with options? Yes, you can do it with options. Don't have to do it with options. But clearly you can see that with the triple play indicators, you can really pinpoint your entries and exits. So go to marketgauge.com/MarketFest to get that special offer, and you're one of the first 25 people. It's all yours. Now, traders often realize that the mentoring is incredibly valuable. The scans are an incredible time saver, and they want it for more than 1 year. So at the end of your bonus year, you can elect to sign up for $97 a month. And I think we will actually make some kind of a discounted offer, but it won't be this discounted. If you decide right now that you want to lock in 2 years and save $864, you can do that for a total of $794. So that's just an additional $297 for that second year that has an $1,100 value. All right, you'll see that option when you get to the order page. But then there's an even higher level of trader who realizes or recognizes the value of the mentoring and of the alerts, and really doesn't like to worry about any kind of recurring charges. Now, yes, you can absolutely cancel them, but if you just want lifetime access to the mentoring, to the scans, it means you'll have lifetime access to everything with no recurring fees whatsoever, and that's just $994. All right, so whatever deal works for you. A full year, $497, gives you everything you need to get started. It does give you the indicators for life. It gives you the training for life. But if you want the mentoring and the scanning for life, then you'll want the best deal at $994. All right, it's your choice. just go to marketgauge.com/MarketFest. You'll see more details in terms of what you'll get, and all you have to do is click on the order form and opt into whichever level of service works for you. So as I've said, I hope that you'll end this presentation feeling like others have, like Dylan, who have said since becoming a Triple Play member, my trading has dramatically improved. I think you can see why that would be the case. You have insight into the trends of the markets that are determining support and resistance like never before. And it's really quite straightforward. Now, whenever somebody sends us something, we always write back an email and say, hey, do you mind if we share that with other members? And so the response from Doug when we said that was pretty entertaining, so I'm posting that too. He says, of course you can post my testimonial. Truth be told, this morning paid for the MMM subscription, which is another membership plan we have, and my Triple Play enrollment. Tomorrow's another day, but at least I'm not sitting in a pool of my own sweat and wondering what just happened to my portfolio. So again, even if all this does is keep you out of trouble, I think it's well worth the investment and the insight. Now, in addition, for those of you who act quickly, we've got fast action bonuses. The first one is an accelerated implementation training. So in this training, it was live in the market, and I went through for about 2 hours and walked members through how to identify the patterns with the most profit potential. I showed them how to identify setups that could trigger trades each day using the Triple Play alerts, and I showed them how to apply the Triple Play indicators to trade setups that you may already be trading, and a whole lot more. Now, this was basically like a fast an accelerated course if you wanted to get up and going in just 2 hours. And if I were to just sell that course, it would be a $397 value, but we will include that as part of this package. And finally, that first accelerated implementation was so well received that I did a special one which would answer your question, Rosa, I think, which is I focused on intraday trading tactics. So the intraday trading tactics enable you to really minimize your risk and identify the best trade days to enter, all right, and even the best days to exit your trades. And it enables you to take advantage of intraday volatility rather than fear it. And again, this is a 2+ hour training session, which has a value of $397. And that will all be included in your $497 or your 2-year or your best deal lifetime membership, whichever you choose. Go to marketgauge.com/MarketFest. All right, so you'll get the training, the indicators, full year of alerts and mentoring, unless of course you go for the lifetime, then you'll get them forever, and 2 bonuses, the fast implementation training and instant access to the intraday entry tactics. All right, so we've got everything covered. Now, I do want to just quickly answer a few questions, one of which is, can you use it for day trading? My answer to that is yes. However, I want to make sure that we're talking about the same thing. All right, so I use it I'm not as active in day trading as I used to be, but I still do take day trades. Now, I use it for day trading on 2 levels. The most important level is to identify which particular symbols I'm going to trade that day. So, for example, I will look for the stock's daily patterns that are set up for an explosive trend day. And you can see by these indicators, I think, how I identify which ones I think are going to have an explosive trend day today, right? So that's how I use it. Now, you can also use it on intraday charts to see turning points in the intraday charts. But what it will not do for you as a day trader is it's not going to give you buy and sell, like a buy now, sell an hour later signal because it's not that quick, okay? It does a really great job at telling you when lows of the days will probably reverse, highs of the days probably will reverse, or which lows and highs you should buy for breakouts. So if you're looking for kind of a day trade that you're trying to catch the trend of the day, then I think it is extremely helpful. If you're really looking for short-term scalping, probably not the right thing. All right, so I'm unfortunately have gone way longer than I was supposed to. Sorry, Jeanette. But I am done now, and I really appreciate everybody's attention today. And if you've got any questions, go to marketgauge.com/MarketFest. We probably have live chat at the bottom. Because of the weather here, there's nobody in today, but leave a message in that box. The only reason I'm not there, maybe I'll go there and answer some questions if you've got any in live chat. It'll take me a few minutes to get there. All right. With that, thank you very much. I hope it was helpful. I hope you pay attention to those 3 different things, and that's all for now.